Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending of May 14th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is the peak near, peak price action. Well, before we kind of go into some of the details, just take a look at where price action kind of unfolded last week. So let's go in here and we'll just take a look at the sound bites here. And the first thing we're going to do, I want to take a look at the index performance. You can see on the index performance, even though we had a very strong close to the week, Thursday and Friday, up a pretty good bit off the lows midweek, everything is in the red. Year to date, we're all in the green. Notice that the Russell is close to giving up year to date performance to the Dow, followed very closely by the S&P. NASDAQ's the one that's taken the most pain. You can see for the week, the worst performing sector was technology, or I'm sorry, discretionary at 3.87. Staples was the best, but the worst performing sector for the year is technology at 6.32%. So technology, especially those work from home stocks, have just totally crushed a lot of the tech sector. Energy, very strong at 31.51%. In fact, energy has kind of led the way all year long as a really good hedge against possible inflation. Resource stocks, energy stocks, commodities tend to do better than, technology, which functions horribly in a rising interest rate environment. You can see the forward PE ratio sitting at 22.57. The dividend yield 1.38%. The 10-year treasury is 164. So the spread between the two is 26 basis points, meaning you can earn that much more annually on a 10-year treasury. But that still kind of channels money into stocks, but not like it was before. So it's going to start to compete with equities as far as where money wants to go. But there's a conundrum in the bond equity ratios. And members, I'll go through some of that tomorrow night in our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. We're doing really well. A lot of our stocks and commodities are up 3x, 4x, 5x from when I came out with a buy list last year. So that is kind of where we're sitting here on the index performance. Now, looking at it, and we look at some of the economic data, we do see that the S&P on Wednesday had its worst day since early February of this year. The Dow had its worst day since last year, October, end of October, when the Labor Department came out with their CPI data, and it jumped by 90 basis points in April. CPI was up 4.2%. So we're looking at the consumer CPI jump in 1 month was the most in 4 decades. That's about 40 years, guys. The CPI rose 4.2%, 12 months year over year. That was exceeded forecast of 3.6%. PPI, producer price indexes, also rose up too. So it does kind of portend inflationary data. And that is why the markets totally crashed on Wednesday. I mean, we just had a very strong pullback. And it could have been worse, but we did see a jobless claims number bigger than an adjusted drop, 473,000. So that was good. And retail sales, even though it's flat for the month, it did follow a huge surge in March of 10.7%. So keep in mind at the low point, and I'll show you the chart in a minute, but the low point on Wednesday of this week, NASDAQ, which is comprised primarily of technology, it was down a little over 8.5% for the week or for the year. Right? It's huge, right? Correction territory, keep in mind, was 10%. All right. So really took it in the shorts. Now, the other thing is if we take a look at the US Treasury market, the Fed officials on Wednesday, when inflation really went through the roof, the vice chair, not Boom Boom Powell, who is the chairman of the Fed, but the vice chair, Clarita, came out and just said, yeah, we were a little bit surprised by the inflation, but we still remain entirely consistent with our goals, and we see inflation pulling back a little bit. Well, if they're right, that'll be a good thing, but that's a big bet. Right now, the markets, they kind of look at it as a 50-50 bet. So we're going to start to see some more inflationary hedges. And again, members, I'll go through some really interesting ways that you can hedge inflation longer term, especially if you're managing a 401k or an IRA. Short term, there's going to be obviously month to month swings in prices, but there's some opportunities starting to set up that I think you guys are going to really enjoy. The bond market kind of taking his cue from Clarita when he came out with his midweek statement. The yield on the 10-year actually stayed below its late March high. So it didn't really go up. We could have continued on down in Thursday and Friday's action if the yields hadn't backed off, but they did. So right now, the bond market is buying this transitory inflationary move here that we're seeing, this short-term inflation. But if that proves to not be transitory, and all the folks that I talk to and the data that I'm reading on the ground with businesses that are supplying everything from lumber and steel and commodities to shipping rates across the ocean, they're all going up, and it's very hard to pull that back once it starts going up. Okay. Now, if we come over and let's take a look at the European theater as well as the Asian markets, you can see just net, most everything was in the red for the week. The DAX, the German index, was flat, roughly at about 11 basis points to the green. China actually had a strong week. Year to date, everybody's in the green. Now, China, that 50 basis points should be in the green, not in the red. So everybody's in the green year to date over the major indexes that we're following globally, right? From the US, as you can see at the top, to the European markets on the bottom down there. You can see that. But last week, even with the strong finish, it was not a pretty week. Okay. And that's kind of what we're seeing here. The other thing, the European Commission revised its economic growth forecast. They moved it from 4.3% for this year up to 4.4% for next year. So they're increasing their growth forecast primarily because they're getting more people vaccinated and they're slowly coming out of their funk and their lockdown. So that is a good thing with the rising vaccination rates and lockdown easing across the region. So that should also help. We also got data out of the UK, Great Britain, that the GDP came in stronger than expected at 2.1%. So I do believe Europe, while they're behind the US because they stayed locked down longer, much like some of the dim governors here in the US around Illinois, California, New York, New England, essentially. They stayed locked up longer than they should have, or Michigan, or some of these others. They're finally starting to relax just a little bit. That's going to help growth in the U.S. also. In China, they actually had a strong week, 2.09%, and which brought up their year-to-date number to in the green. Like I said, it should be 50 basis points in the green instead of in the red, as you see on your screen there. But they had huge auto sales, 13 months in a row, 8.6% year-over-year growth in their auto sales. Their PPI jumped to 6.8% in April. That's the largest gain since 2017 as raw material prices surged. As these prices go up, they're going to be exporting inflationary data over here to the U.S. and Europe as we buy more expensive goods from China or import more expensive goods. So we've got to be really careful in these markets, folks. I mean, we have to watch it very closely because these things can have a tendency to get ahead of themselves. What I want to do is shift you over to some of the charts, and I'll take a look with you at what I'm seeing here. So let me just switch the screen. Let's just move it over here like this. Let's get you over to the S&P 500 E-mini futures. And keep in mind, in our reviews, especially for our members, one of the things that we do when we talk about commodities and futures, I give our members a choice of a futures trade or a commodity trade rather than using futures as the instrument to reflect your bias, doing ETFs, because almost all the commodities, just a rare exception of just a few, you can find an ETF that you can play, and a lot of them have huge volume. So you don't have issues if you want to do the stock or the ETF, or you want to do the options on the ETF. But if we look here right now, what you see is the S&P 500 E-mini futures. You can see how we kind of bounced right off the 50 EMA. We don't stay down below the 50 EMA very long. The red line is the 50 EMA. You can see we're off the all-time highs, but we're not that far off. Now the issue is you can see just how deep the MACD moved on this very fast move here. Okay. Now, what we're going to be watching and what I'm going to have our members watch very closely is, are we going to make new all-time highs? Or are we going to come up and fall short and start to run into a chop mode and then have a longer, shallow channel coming back down to test these lows again? These are going to be key things to watch, okay? If we make new all-time highs, then any pullback, we're still in a buy the dip mode. And by the way, on this pullback here, we're still in a buy the dip mode. I mean, that's where we want to be right now. I don't see anything that would suggest otherwise in this mode here and buy the dip. So if we look at this, and what I want to do is let's just shift over and look at some of the other areas here. Let's look at NASDAQ. If we look at NASDAQ, you can see here it blew through the 50 EMA, actually came down, almost went flat for the year. This is the NASDAQ NQ. So it's the NASDAQ 100 futures, 100 of the largest companies, tech companies, mega cap companies, technology-wise generally, and then NQ. And you can see it really was damaged. We're still below the 50 EMA. If this rolls up and rolls back over because of the weighting that they have in the S&P, it will have a tendency to drag down the S&P too, I believe. And we were down, like I said, about 8.6% off the all-time highs that were made over here on the April 29th. Okay, so we've got to watch that very closely. Now look at the Russell. If I show you the Russell futures here, let me just find it on my screen. I know it's around here. Here we go. The Russell futures, it has broken its upsloping trend line. It came right up and it's sitting right over. It closed right up over its 50 EMA, which is this red line right here. Okay, we broke it, came down, and then just closed right up above. Now, I will remind you that year to date, the Russell is up 12.55%. So it's still fairly strong, but it's showing a lot of chop and a lot of weakness. And unless we can clear this trend line and get back up here, this vector is no good anymore. And that means we've moved to a sideways move, which then means we've moved down. Keep in mind that the way the markets move, okay, the way the markets move, topping actions are very ugly. Bottoming is usually very fast and sharp. We have a blow off bottom, we move up, and then we come down. We may do a retest, but inevitably we don't. We form a bullish divergence on the MACD, and then away we go. Topping actions can be ugly and can take 6 months to a year. So we could be in a longer term topping action, because keep in mind, outside of that fast bearish move, when we went into an official bear market last March, which was a black swan forced event, the economy would not have moved into a bear market with that. You know, we may have had 7, 8, 10% pullbacks or corrections, but not a bear market. The COVID crisis did that. And because we were so strong going into it, we're strong coming out as stocks start to reopen again. And for members, this Sunday evening, I'll go through some really interesting plays on the reopening trade as well, which are going to be completely different than the work from home trades. So if we look at this, you can see the Russell is gotten a lot weaker here. Now, one chart I do want to show you, if we take a look at the Dow, remember the S&P 500 E-mini futures bounced pretty much off the 50 EMA, right? And it closed below it one day and then it bounced back hard back up. If we look at the Dow futures, let me just find it on the screen here. I know it's on here. I got so many of these damn things on here. Here we go, right here. So if we look at the Dow futures, same thing, right? In fact, it's a little bit stronger. You can see where it comes down at intraday, it goes below the 50 EMA, but it always closed above it. Same thing here. So if we've got an all-time high in the Dow futures that was made on May the 10th, it was 5 trading days ago, okay? May the 10th. And if we look at the Dow Jones Transports, IYT, and we see here the Dow Jones Transports also made an all-time high on May the 10th. So on May the 10th, we got all-time highs in the Dow Transports and the Dow Futures. So that tells me that the markets fundamentally are still very strong. Okay. Typically, Dow theory says that the Dow Transports leads the market higher and lower. And when you're getting both the Dow Transports and the Dow Futures hitting all-time highs very close to each other, it's a strong bullish market. Now, this is a different market compared to what we've seen in the past because we've got that reopening issue. We got vaccine issues. We got a ton of stimulus going into the markets, which are doing an inflationary scare. So you can't always rely on what's happened in the past with some of these key indicators based on where we are right now. So there's certain things that we're going to watch very closely to make sure they kind of fall in line. Let's look at China. The tracking stock for China, ASHR. Notice we were almost in a bear market on China back on March 25th. We're still in the red slightly on this tracking stock for China. Okay. And the reason why China has come down so hard is that the Chinese government has come out very tough against technology companies, especially social media companies, because they don't want these social media companies that are Chinese based to be very strong. They don't like the idea of consumers there getting together and bonding together and passing along news and things like that. This typical communist country, they don't want to, they want free flowing news. They do not want it, like what the the Democrats are trying to do here, I guess. But they don't want it there. So that's number one. Number two, they're coming out with more are cutting back on some of their stimulus. They don't have the issues that we've got here, where you've got to win the electorate and then you're only as good as your last press statement, right? Over there, they don't have those kind of free flowing elections. So they can do what they need to do. What we would need to do here in the US is cut that stimulus, take a hit to price action because we would. It would reduce the PE ratios. PE ratios are high now because of low interest rates. Cut that back, raise the interest rates, and then get the economy more in a value-based mode. But this shows you what's going to happen when the Feds start to come out and cut back stimulus. Remember, we're doing 120 billion a month in stimulus. 80 billion of it is buying treasuries. The other 40 billion of it is buying mortgage-backed securities. So they're keeping the 10-year treasury note very low. And usually most mortgages are based on the 10-year treasury note because the average life cycle of a mortgage loan is a little bit under 10 years. But they're keeping it very low. When that stuff starts to come back off the table again, and then the free market is going to come in and start buying a lot of these treasuries in auctions versus the Fed, they're going to demand a higher price or a higher interest rate to buy these things. That's going to jack up the rates. We're not there yet, folks, but we got to be very, very careful. Okay. So that's what's going on in the major indexes. Now, of course, if we look at volatility, the VIX, even though we had this huge spike, you can see where we started from over here in the prior week. We went all the way up. We actually had a spike up to 28, 29, and then we gave it all back up in a two-day period here. Okay. And if we come over and we look at our front month term structure, we're in the green again. We were in a backwardation in the term structure in the red, which means there's fear in the front month of volatility. So we watch these very closely. If we look at the back month, and if you look at the term structure in the back month, intraday, this is a daily chart. Intraday, we did move into the red on Wednesday, but it came out very quickly. And we closed way back down. So we've never really had a closing print that showed we were in backwardation on the back month term structure for volatility. So one of the things that we use to help us measure just how afraid is the market versus just normal pullback activity are these term structures. And they work out very well. Okay. If we look at the bond market, check this out, guys. The bonds never really were able to climb over their 50 EMA. Now, I have said back over here, back in Q4 of last year, when the bonds hit the 50 EMA, short it. It's just a time to jump in, and it's been a great trade for us. I've got a target down here of about 151 in the bond market. Now, there are other ways to play it with ETFs, but this would be the target here. If we get that pullback later this summer, which is what I'm calling for, of a 7 to 12% pullback. Remember, we've had almost an 8.5 in technology since the 2020 March 23rd lows of COVID. We've had about 7 pullbacks, and the average has been, I want to say, somewhere between 5 and 7%. Most of them been like that. We've had about a 4.8% pullback in the E-minis over the past week on that little down move on Wednesday, but I'm still expecting double that move lower. And I think we could probably get it in the summer. We're still in a buy the dip, but these dips are still relatively shallow right now. I'd like to see a bigger pullback. But you can see the bonds here, and let's take a look at interest rates for the week. You can see interest rates, they actually came down on Thursday and Friday, but they were moving higher earlier in the week. And you can see in this instance here, I'm calling for an interest rate over the next 90 days of coming up to about 1.88. So if we do have a harder pullback in the markets, bonds are going to be going down while equities are going down. It's not going to be offering as much protection as some investors think, because what's going to drive that pullback more than likely is higher inflation. All we need is to get another CPI print like we got, and we start to see economic data showing that inflation is coming in hot. And if we do that, you've already seen, based on Wednesday of this week, what price action is going to want to do. Let's go look at currencies. If we look at currencies, well, the dollar is moving back lower here, and I believe the dollar is going to come back down and test and break the 2021 lows. Okay, we may run up to the 50 EMA like bonds. As it runs up here, I would short it and play it to the downside, because they're destroying the dollar with the stimulus. Right now, granted, when we have sudden shocks to the market like we had on Wednesday, you can see that green bar there. Money rushes into the dollar in times of safety, seeking safety. But when it disappears, the dollar reverses and goes back to its trend, in this case to the downside. I like the euro to the upside, guys. We've had a pretty good pullback here. I believe the euro is going to eventually make it up to my target of 128. Okay. We've regained the 50 EMA. Longer term, there's great ways to trade the euro with ETFs, or you could trade euro futures. I like that better than Forex. You just directly trade the euro. Now, you could go long euro dollar, which would be a good trade, but I just like either the futures directly into the euro currency, or the ETF that tracks it. Okay. Now, if we come down here and we look at metals, let's look at gold. Gold had a strong day. All right, look at this. It's breaking out. I like gold longer term, and I said if we can break out of this over 1815 area, I like gold longer term. So there's a number of ways to play gold futures and or gold ETF. Trading options on the gold futures is a great way to go if you've got an account that can do it. Otherwise, ETFs make sense to me. Also, let's look at copper. Copper's been one of our longer term trades. It's moved up. It's probably going to settle in. That was my original target, around 4.45. We came right up, and notice we stayed there for a week, and then we moved up above and retested it again. Would not be surprised to see a retest and kind of a longer period consolidation before moving higher. So I got everybody long copper back over here. Now, there was an ETF that we were tracking that were played very well with it, but we had a number of members take the commodity or the futures, and it was just a home run trade. It went up about 450%. Really great trade. Some other commodities have done just as well. Okay. If we look at energy, let's look at oil. Okay. Oil, it is in this. Now, once we got up at this level here, I told our members to fade this move, which means trade sideways pattern. You can do broken wing or unbalanced flies. I like it in the futures market, but there's ETFs that you can track that you can play this as well. But I do like this. trade sideways. If it does move up here, it'll be spike and then it'll pull back. So I kind of like oil in a sideways pattern. Okay. Nat gas. Well, every time nat gas has gotten up, I want to see it get over 3. It's at 295. If it can just eke up there, I would like that because then I would be more willing to short it. Okay. Because nat gas is a short. We got more natural gas and we know what to do with. But it is a short up at this level. It is not a long, right? Right now, it's a no trade because I'm waiting to see what we can get out of it, all right? And then the other one, which is really good, is gasoline futures. If we look at gasoline futures, well, again, going back to last year, it's just been off to the races. We've had this divergence here, so a little bit of a fade to move makes sense. We're going to be in a choppy period for a bit of time. Even though the pipeline shut down and gas has been jacked up. Remember, when you look at the futures market and gas prices, you got to kind of go out about 3 months in time because it generally takes about 3 months and looking at a futures price to see how it's reflected at the pump because they got to pump it out of the ground. They got to refine it, and then they got to divide off the refining into diesel and gas, leaded, unleaded, break it out into distillates and all sorts of things. And by the time they put it on a truck and get it to the pump, you're 90 days away, right? Sometimes a little bit longer than that. But futures reacts very sensitively to a go forward of about 90 to 120 days of where they think it is. But gasoline, just going through the roof. Since last November, gasoline futures was about $1 a gallon, and now it's sitting at 2.12. That's a huge move in gas futures, guys. Huge move. All right. Now, if we come down here, and one other thing I want to show you in the softs market, look at lumber. Lumber is starting to give it up. Okay. But like I told you before, a great trade in lumber, and there unfortunately is not a ETF that really tracks this, but there are some stocks that track lumber that you can play on. I'm looking for lumber to come down, make another run, which I think it may, and then fail on that second run. That would be the opportunity to short. Okay. Trying to short here is like standing in front of a train. You really don't want to do that. Now, there's other plays in commodities, whether we're talking meats, agriculture, or other softs. But right now, that's kind of what I'm looking at, guys. Members, I will go through in more detail with you ways to hedge or play inflation or some of the reopening trades that we've talked about before, as well as looking at some interesting new stock plays also. If you're not a member, I highly encourage you to come in. I think you'll enjoy it. We're doing well with these markets, and I think it's going to be very interesting how we move forward through the remainder of this year and kick off 2022. Have a great weekend, everybody. Members, I'll see you tomorrow night. Thanks, folks. Ciao.